I'm going to be taking UPSC's previous year's questions for the last 10 years. So when we do these questions, I would want you to at least focus on elimination of certain options and see how do we approach certain questions when we appear for civil services examination. What I'm going to be looking at is each statement, and in each statement, I am only going to be thinking as to why that statement is wrong. I'm not going to be looking for why a statement is right. I'm actually going to be looking for why a statement is wrong and using those statements to eliminate options. And based on the selected options after elimination, I have to pick the right answer. Let's take the first one. Hello and good evening. My name is Ranchan and I'm going to be taking UPSC's previous year's questions for the last 10 years. So we'll be discussing questions based on Indian economy that have appeared since 2015. What I've tried to do in this session is that I've tried to classify questions basis multiple subtopics as are a part of your syllabus itself. So when we do these questions, I would want you to at least focus on elimination of certain options and see how do we approach certain questions when we appear for civil services examination. The first topic that we are going to be picking up is money supply, monetary policy, as well as the banking sector in India. Now, this is apparently the most important section when it comes to the prelims examination. And when I discuss these questions, my focus will be to use this approach, which is what I like to call the negative approach towards attempting civil services prelims questions. What I mean by the negative approach is that when I'm looking for selecting the right option amongst the four options presented, what I'm going to be looking at is each statement, and in each statement, I am only going to be thinking as to why that statement is wrong. I'm not going to be looking for why a statement is right. I'm actually going to be looking for why a statement is wrong and using those statements to eliminate options. And based on the selected options after elimination, I have to pick the right answer. You will understand this as I solve each of these questions. Let's take the first one. The first question is a question which was asked in 2024. The question says, with reference to the rules imposed by the Reserve Bank of India while treating foreign banks, consider the following statements. Which of the statements given above is or are correct? Now, there are two statements presented. We have to select which of these statements are correct. The first statement says, there is no minimum capital requirement for wholly owned banking subsidiaries in India. Now, you can clearly understand that if you have studied the chapter on banking, RBI has a stringent requirement when it comes to giving away banking licenses. RBI has a requirement for what is called bank's own capital. For example, the minimum paid up equity to set up a bank in India is 500 crores. Now, for you to get a license for a bank in India, if your paid up equity capital has to be 500 crores, you have to think logically, why would RBI ensure that for you to own a banking subsidiary in India, there should be no minimum capital requirement? If you have studied the chapter on banking, ever since the Basel Committee on Banking Supervision came out with its recommendations, there has been a continued focus and a renewed focus on having a bank's own capital. This is to provide resilience to shocks, resilience to cover up for losses also. So if you are a logical candidate, you will look at this statement and you will automatically know that obviously the Reserve Bank of India has to have some minimum capital requirement for wholly owned banking subsidiaries. So when you know that option 1 is wrong, that means the question is which of the statements given above is or are correct. That means 1 only cannot be right. Similarly, both 1 and 2 cannot be correct because we know that 1 is wrong. The second option says, for wholly owned banking subsidiaries in India, at least 50% of the board members should be Indian nationals. Now, the first statement is a statement of information. However, you can use some logic to eliminate the first statement, given that you know that there has been a continued focus on ensuring that banks have their own capital to provide them resilience against shocks, resilience against losses. So logically thinking, the first statement appears to be obviously wrong, which it is. The second statement is a statement once again on information. You may know this, you may not know this. Now, clearly, if you have come here, the second statement, when you read it, you said for wholly owned banking subsidiaries in India, at least 50% of the board members should be Indian nationals. Now, there is some amount of information here, which is that the requirement is that at least 50% of the board members should be Indian nationals. They could even be non-resident Indians. They could even be persons of Indian origin. Now, amongst these three, persons of Indian origin are not Indian nationals. Right? Obviously, statement 2 is wrong. There is one more requirement. The requirement is that minimum of 1/3 of board members should be Indian nationals, and such Indian nationals which are also resident in India. That has been the recommendation when it comes to banking subsidiaries and their boards. Statement 2 is also wrong. The answer should be neither 1 nor 2. Now remember, if you were logical, you would at least know that statement 1 is wrong. And if you know that statement 1 is wrong, you are able to eliminate 2 options. While you are attempting or while you're looking at this video, try to see how many questions are these questions where you can eliminate 2 options, and basis the remaining 2, try to pick one of the answers. And towards the end of the video, for all the questions where you have eliminated 2 options and you have still attempted those questions, please do a separate analysis as to how many of these questions were right and how many of these questions were wrong. This is only to tell you that if you attempt more questions, especially those where you can eliminate 2 options, there is a high chance, high likelihood that your total score is going to increase. Do that, please. Now, the second question is one on, consider the following statements. First one says, in India, non-banking financial companies can access liquidity adjustment facility window of the Reserve Bank of India. Now, the liquidity adjustment facility window of the Reserve Bank of India involves what you call the indirect instruments of monetary policy. That means the marginal standing facility rate, the repo rate, the reverse repo rate, the standing deposit facility rate, and the bank rate. This is what you call the liquidity adjustment facility. Liquidity adjustment facility is a facility in which banks which are facing temporary liquidity mismatches get their funds from the RBI, or the RBI uses some of these instruments to absorb excess liquidity from the banks itself. Now, in India, the de facto availing of liquidity adjustment facility is only provided to scheduled commercial banks. That means if you are a scheduled commercial bank, you automatically enjoy the liquidity adjustment facility. If you are any other bank, you will be given an option to use the liquidity adjustment facility, but only at the discretion of the RBI. The statement says, in India, NBFCs can access the liquidity adjustment facility window of the Reserve Bank of India. That makes this statement wrong. It's only the SCB, scheduled commercial banks, which de facto enjoy the liquidity adjustment facility. Once again, now you know that option 1 is wrong. That means, so which of the following statements given above are correct? That means you eliminate A, you eliminate C, and now you're left with B and D. B says 3 only, and D says 2 and 3 only. That means 3 has to be correct. The only thing you have to look for is statement 2. Statement 2 says, in India, foreign institutional investors can hold government securities. The statement obviously is a statement of information. You should know this because it's expected out of every serious candidate. In India, yes, FIIs are allowed to hold government securities. In fact, there are 3 mechanisms of holding it. One is called the voluntary retention route. Another is called the fully accessible route. And the third is called medium term framework. So in India, are FIIs allowed to hold government securities? Yes. The answer should be, once you know that statement 2 is correct, that means between B and D, the answer clearly has to be D. You don't even have to look at statement 3 if you knew that first statement was wrong. You eliminate all the options which had statement 1. You were left with only two options, B and D. B says 3 only and D says 2 and 3 only. That means 3 only should be correct. You have to look for statement 2, which is also correct. Statement 3 says in India, stock exchanges can offer separate trading platform for debts. If you have heard of something called NDSOM, Negotiated Dealing Settlement Systems, order matching, this is a, you can say, platform which is owned by NSE, which is separately meant for trading in government securities. That means government securities are debt securities. That obviously should mean that yes, in India, stock exchanges can offer a separate trading platform for debt instruments. That means the answer should be D. Once again, the focus has to be that if I was able to eliminate one option, then I was left with only to evaluate statement 2. And if I knew that statement 2 is correct, then the chances of me getting this question right are almost absolute. Now we'll move to the next question. The next question says, consider the following statements. Statement 1 says, syndicated lending spreads the risk of borrower default across multiple lenders. Statement 2 says, the syndicated loan can be a fixed amount or a lump sum of funds, but cannot be a credit line. Which of the following state is correct in respect of the above statements? And the options are both statements 1 and 2 are correct, and statement 2 is a correct explanation of statement 1. The other option is both statement 1 and 2 are correct, but statement 2 does not explain statement 1. C is statement 1 is correct, but statement 2 is incorrect, and D is statement 1 is incorrect, but statement 2 is correct. Statement 1 says, syndicated lending spreads the risk of borrower default across multiple lenders. Now you should know, if you only know the meaning of a syndicate. Syndicate typically is used for a group, usually in context of economic offenses. The word syndicate is a negative connotation of a certain word. Like this is a group which tries to create a fortune by working in the financial sector or by working in the sector which deals with money itself. Typically, that's what you use the word syndicate for. However, that negative connotation of syndicated lending is not involved here. Syndicated lending basically means that if there is a big loan, rather than having only one bank be exposed to the entire loan amount, in which case if the loan gets defaulted upon, all of the credit exposure is for bank 1 itself. Therefore, bank 1 stands to lose a lot, which means that if there is a big loan, if we reduce the exposure of each individual bank, for example, let's divide this loan across 3 banks. Now, these 3 banks are going to form a syndicate. Each of these banks is going to give part of the loan amount. That means in case of a default, each of these banks stands to lose a little less compared to a scenario where one bank had all the credit exposure for a big loan. This is what the concept of syndicated lending is, which is where the risk of default gets spread across multiple banks. That means statement 1 is correct. If statement 1 is correct, clearly option D cannot be the right answer, because option D says statement 1 is incorrect, but statement 2 is correct. So you eliminate option D. Now the answer has to be between A, B and C. Statement 2 says the syndicated loan can be a fixed amount, lump sum of funds, but cannot be a credit line. Once again, this is a statement which you would either know or you would not know. Ideally speaking, now you should know the statement. The statement is it cannot be a credit line, which is incorrect. It can be a credit line, it can be a fixed amount or a lump sum amount, or it can be a combination of both. A credit line is different from a fixed amount in that in case of you borrowing a fixed amount, the entire interest you have to pay on the principal. In case of a credit line, there is a range of money that you can borrow. For example, somebody gives you a credit line of $25 million. That means the maximum you can borrow from that line of credit is $25 million. You can borrow anywhere up to $25 million and you will have to pay interest only on the borrowed amount. It works something very close to like a credit card works. Now statement 2 is incorrect, statement 1 is correct. That means the correct answer should be option C. Statement 1 is correct, but statement 2 is incorrect. Move to the next question. This one says, in the post-pandemic recent past, many central banks worldwide had carried out interest rate hikes. Statement 2 says central banks generally assume that they have the ability to counteract rising consumer prices via monetary policy means. Once again, the options are pretty much the same. Both statement 1 and 2 are correct. Statement 2 is the correct explanation. Both statement 1 and 2 are correct, and statement 2 is not the correct explanation. Statement 1 is correct, but 2 is incorrect. Statement 1 is incorrect, but statement 2 is correct. Now, you may or may not know, although in this exam, in this year's particularly, there was a lot of news around this specific topic itself. So you should ideally be knowing this if you're sitting in 2023. But even if you don't know this, let's look at statement 2. Statement 2 says central banks generally assume that they have the ability to counteract the rising consumer prices via monetary policy means. You should know, if you have been a decent student, you would know that central banks have at their preserve what is called monetary policy. And monetary policy essentially targets what is called price stability. That means if there is a scenario of inflation, if there is a scenario of deflation, central banks have at their disposal what is called monetary policy. There are quantitative tools of monetary policy, direct and indirect, which can be tweaked to control prices or to stabilize prices. So statement 2, normally speaking, is correct. Now, if statement 2 is correct, quite obviously, you can eliminate option C, because option C says statement 2 is incorrect. Now, you're left with only 3 choices. Now, think of it logically. Statement 2 says central banks generally assume that they have the ability to counteract rising consumer prices via monetary policy means. Yes, it is a correct statement. You would know this. If statement 1 were true, then this would be a good explanation of it. Statement 1 says, in the post-pandemic recent past, many central banks worldwide had carried out interest rate hikes. Now, it can be a false statement or it can be a true statement. If it is a true statement, in which case, statement 2 is a great explanation for statement 1. Why were central banks rising interest rates? Because they wanted to control prices. That means if the answer has to be there, it could be between option D and option A. Why? Because statement 2 is not the correct explanation for statement 1. That does not hold the ground. If statement 1 is correct, then statement 2 explains statement 1 rather well. Now you have to take a chance between option A and option D. Option A says both statement 1 and 2 are correct. Statement 2 is the correct explanation of statement 1. And option D says statement 1 is incorrect while 2 is correct. Now it is a choice between 2 options, and you should know that in the post-pandemic recent past, think of it logically, in pandemic, what happened was many people delayed their consumption decisions. That means since there was a lot of uncertainty around what is going to happen to the world, right, post-pandemic, many people decided to hold back their expenditure or their consumption decisions. Once things became a little normalized, people started demanding more things in what is called pent-up demand. This word, this phrase, pent-up demand, was used very liberally in the post-pandemic world because there was a huge pent-up demand. More demand chasing fewer goods and services led to inflation, and because of inflation, central banks acted by carrying out interest rate hikes. So statement 1 is correct, and statement 2 is also correct, and statement 2 is a correct explanation of statement 1. Once again, on the easy side of the questions. The next one says, which of the following activities of the Reserve Bank of India is considered to be a part of sterilization? Now, sterilization means that Reserve Bank, as part of its price stability function, has 2 things at its disposal: monetary policy and open market operations. Sometimes what happens is that Reserve Bank may have to take recourse to open market operations to stabilize prices. A case in point would be, for example, dollar inflows in the economy increase. If dollar inflows in the economy increase, this is going to lead to an appreciation of rupee. And if the rupee appreciates, since forex management is also a part of the Reserve Bank's function, we follow what is called a dirty float system, wherein RBI is going to act in case of excessive fluctuations in the exchange rates. Imagine that this fluctuation is excessive. For RBI to control this rupee appreciation, what the RBI is going to do is, RBI is going to buy these excess dollars. When RBI buys excess dollars, it is going to be buying this excess dollars by putting rupee into the system. And if more rupee is put into the system, you have a scenario of more money chasing fewer goods. This is a scenario of inflation. To control this inflation, what the RBI is going to do is RBI is going to take recourse to open market operations, where RBI absorbs this excess rupee by doing what? By selling bonds which are called stabilization bonds. By selling bonds, RBI absorbs this excess rupee or this excess liquidity and controls prices. This entire operation is called sterilization. Why? Because the effect of one of the functions of RBI had to be sterilized or had to be neutralized by another option of the, or the other, you can say, instrument of the RBI itself. So if the question is, which of the following activities of the Reserve Bank of India is considered to be a part of sterilization? A is conducting open market operations. Straight away, this is the right answer. You don't even have to look at the other options. Move to the next question. With reference to the central bank digital currencies, consider the following statements. First one says, it is possible to make payments in a digital currency without using the US dollar or the SWIFT system. Now, since central bank digital currencies had been a matter of debate in the last couple of years, ideally you are expected to know this. Is it possible to make payments in digital currency without using the US dollar or SWIFT system? Now, SWIFT system is the Society for Worldwide Interfinancial Telecommunication System. That means if you have to make transactions between one country and the other country, the network you're going to use, the technology you're going to use is going to be called the SWIFT system. Also, if you are making payments or if you have payment obligations to other countries, one of the most frequently used reserve currency is the dollars. By having a central bank digital currency, one of the advantages is that you can circumvent this particular system and you can be making payments solely in your digital currencies without using the SWIFT system or without using the dollar as a reserve currency. That means statement 1 is correct. Statement 2 says a digital currency can be distributed with a condition programmed into it such as a time frame for spending it. Since it is a digital currency, yes, I mean, it may surprise a lot of people. Yes, it can be pre-programmed that its life in the system is X amounts of time. After the time is over, this particular currency will also dissipate. This particular feature has been brought in primarily to make sure that all the money gets spent within time to bring in efficiency into the, especially into the public spending aspect of the economy. This is also a statement which is correct. Which of the following statements are correct? It is option C, both 1 and 2. The next question says, consider the following statements. Self-help group program was originally initiated by the State Bank of India by providing microcredit to the financially deprived people. Now, this is a part of the banking sector. You should know that the microfinance revolution, many people give the credit to microfinance revolution to Muhammad Yunus of Bangladesh, and this revolution is also famous for the rise of this bank which is called the Grameen Bank. Taking recourse from this particular revolution, it was not the State Bank of India, rather it was the RBI. In fact, primarily it was NABARD and RBI which piloted and initiated the growth of self-help groups in India. In fact, in the early 90s, if I'm not mistaken, 1992 is when they started what is called the SHG Bank Linkage Program, which was not started by the State Bank of India, rather by RBI and NABARD. That means option 1 is incorrect. How many of the above statements are correct? Many people think you cannot eliminate options here. If you know that statement 1 is incorrect, that means all the 3 cannot be the answer because one of them is definitely incorrect. Statement 2 says, in an SHG, all members of a group take responsibility for a loan that an individual member takes. Yes, that is the purpose behind setting up an SHG. This is what is called collective responsibility, which is to say that an SHG functions so well if all the members develop good savings habits as well as develop a good credit culture by making prompt repayments. The responsibility of the loan taken, even if it's by an individual, falls on the entire group, not on the individual concerned. This is a basic question on, or a basic statement on the functionings of an SHG. This is the correct statement. That means none cannot be the answer because one of them is correct. Statement 3 says the RRBs and scheduled commercial banks support self-help groups. Yes, in the bank SHG bank linkage program, both the scheduled commercial banks as well as the regional rural banks, they do support the SHGs. Now, this is a statement which you, even if don't know factually, you can logically say that, of course, like this has to be supported by the banks. It has to be supported by the regional rural banks. That means the answer which is correct is option B, only 2. Move to the next option. Next question. It says, with reference to the Indian economy, consider the following statements. Which of the statements given above are correct? Every time you find questions like these where we are given a combination of statements, you always have to work with elimination. That means you don't have to look for statements which are correct. First, look for statements which are obviously incorrect and use it to eliminate options. Statement 1 says, if the inflation is too high, the Reserve Bank of India is likely to buy government securities. Now, this is a statement that you can commonsensically tell is wrong. Why? Because inflation is what? Inflation is more money chasing fewer goods. If there is already more money into the system, why would RBI buy government securities? If RBI buys government securities, it will inject rupee into the system. Why would RBI want to inject more rupee into the system where there is already more money floating in the system itself? This is going to further lead to more inflation, not control it. So clearly, option 1 is wrong. If option 1 is wrong, statement 1 is wrong, that means all the options here which have statement 1 will obviously be wrong. That means you eliminate A, you eliminate C, you eliminate D, and you're at your right answer, which is option B. You didn't even have to look at statement 2 and statement 3 if you could logically tell that this first statement is wrong. Statement 2 says, if the rupee is rapidly depreciating, RBI is likely to sell the dollars in the market. Now, rupee depreciating would mean that if you draw the demand supply curve of dollars in the economy, this is rupee to a dollar, and this is the quantity of dollars. One cause of rupee depreciation would be that the supply curve for dollars shifts to the right. That means imagine that you had to give 50 rupees for a dollar. Now you have to give 30 rupees for a dollar. Now this is a case of appreciation. If the question is, if the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Now when the supply curve for dollars shifts to the right or the supply increases, right, that means that the rupee has to appreciate because the rupee is becoming stronger in comparison to the dollars. Previously you had to spend 50 rupees to get a dollar. Now you have to spend 30 rupees to get a dollar. That means if the supply curve shifts to the left, the exchange rate is going to increase from 50 to 60 for a dollar. This is a case of rupee depreciation because now your rupee is weaker compared to the dollar. Now, supply side factors could be one of the factors which lead to appreciation or depreciation. There could also be demand side factors. Demand side factors in the sense that if there is a greater demand for dollars, in case of a greater demand for dollars, clearly there can once again be a scenario of depreciation of local currency. Now there is a greater demand for dollars compared to the supply. RBI is going to do what? RBI is going to increase the supply of dollars into the system. If RBI increases the supply of dollars into the system till this point, right, that means it has to push the supply curve from S1 to S2, then you will be able to stabilize the exchange rates. That means, yes, if the rupee is depreciating, RBI is likely going to sell dollars in the market. If it sells dollars in the market, it's going to shift the supply curve to the right, bringing the exchange rates back to where it were previously or trying to stabilize it. Third is, if interest rates in the US or European Union were to fall, that is likely going to induce RBI to buy dollars. This is once again one of the likely reasons as to why RBI is going to buy dollars if the interest rates in the US and European Union are going to fall. If the interest rates in the US or European Union are going to fall, that means compared to US and European Union, it could be that interest rates in India are higher. And if interest rates in India are higher, many savers would want to switch over to India to make savings here. When they come over to India to make savings here, they will likely convert their dollars into Indian currency or their euros into Indian currency, which means that there will be greater supply of dollars compared to the previous one. If there is a greater supply of dollars, it is going to lead to what? It is going to lead to an appreciation of domestic currency. And there is an appreciation of domestic currency. What is the RBI going to do? RBI is going to buy these excess dollars to pull the supply curve back to where it was previously to stabilize the exchange rates. That means statement 2 and 3 are both correct. Like I said, you didn't even have to know whether statement 2 and statement 3 are correct if you knew that statement 1 is definitely incorrect. Let's move to the next question. In India, credit rating agencies are regulated by the Reserve Bank of India. Now, this is a question on information. In India, are credit rating agencies regulated by the RBI? The answer is no. They are regulated by SEBI, not RBI. That means 1 is incorrect. That means 1 and 2 only could not be the answer. 1 and 3 only could not be the answer. 1 and 2, 1, 2 and 3 cannot be the answer. You automatically know that the answer is option B, which is 2 and 3. If you knew that statement 1 is wrong. Always in these kinds of questions, look for statements which are obviously incorrect. Now, option 2 says the rating agency popularly known as ICRA is a public limited company. This is a correct answer. Brickworks Ratings is an Indian credit rating agency. This is also a correct answer. Now, between these three statements, statement 2 and statement 3, there is a less likelihood that you would know them by heart. But statement 1 is a statement where UPSC leaves some scope for you to try to make a guess. If there are to be credit rating agencies in India, right, for example, an S&P 500, for example, a Fitch, for example, an ICRA, for example, Brickworks Ratings, right, would they be regulated by the RBI or would they be regulated by the SEBI? Right? Clearly, they will be regulated by the SEBI. So, if you can logically make that guess, if you know or if you go with option 1 being wrong, you're automatically at the right answer. You don't even have to look at the other two options. Let's move to the next one. With reference to the Bank's Board Bureau, which of the following statements are correct? First one, the governor of RBI is the chairman of the Bank Board Bureau. Now, back in 2022, if you had read your newspapers, you would know that the first chairman of Bank Board Bureau was Mr. Vinod Rai. Mr. Vinod Rai happened to be the CAG of India. He was an IAS officer. He was never the governor of the Reserve Bank of India. Only if you knew this kind of an information, you would automatically know that the governor of RBI does not have to be is not de facto the chairman of RBI. So option 1 is incorrect. That means select the correct answer. Option A can be eliminated, C can be eliminated, once again D can be eliminated. You're damn at the right answer. That means statement 2 and statement 3 have to be right. Statement 2 says the Bank Boards Bureau recommends for the selection of heads for public sector banks. Yes, initially in its conception, not only did it recommend the selection for or recommend candidates for selection of heads of PSBs, right? It also recommended it for financial institutions. Eventually, financial institutions part of the deal was taken over by the FSIB, the FISB, sorry, not FSIB, Financial Institution Services Board. Option 3 says PBB helps the public sector banks in developing strategies and capital raising plans. This is also a correct option. Now, only if you knew one part of the statement, which is that Vinod Rai Saab happened to be the first chairman of the Bank Boards Bureau and he was never the RBI governor, clearly you would be getting to the right answer if you could eliminate option 1. This is the skill that you have to hone if you want to be very good with prelims examination. Move to the next question. Which of the following is responsible for maintaining price stability by controlling inflation? Now, you should know this as a serious candidate. You would know that controlling inflation is the responsibility of the Reserve Bank of India. It is also the responsibility of the government. The government has at its disposal certain administrative steps. The government also has at its disposal what is called fiscal policy. For the Reserve Bank of India has what is called the monetary policy to effect this function, which is price stability, which is to say controlling inflation or deflationary circumstances. Now he says, which of the following is responsible for maintaining price stability by controlling inflation? First one says DCA, Department of Consumer Affairs, Expenditure Management Commission, Financial Stability and Development Council, and option D is Reserve Bank of India. You don't even have to think about it, right? You should know that after the Urjit Patel Committee recommendations, the chief objective of the monetary policy framework was price stability alongside growth through inflation targeting. So that should tell you that yes, we do target inflation. RBI does target inflation, but it's not the sole responsibility of the RBI. There is also the government which can take administrative steps, such as effecting what is called the Essential Commodities Act, or the government also has at its disposal what is called the fiscal policy, which is about taxation as well as about expenditure and even about public debt for that matter, right? This is used to control inflation in the economy. This is a blinder. You don't even have to think about it. Clearly, you're going to get the right answer, probably the easiest question in 2022. Next question says, the governor of the Reserve Bank of India is appointed by the central government. This is the correct answer. It is the Ministry of Finance which appoints the governor of the Reserve Bank of India. The second statement says, certain provisions in the Constitution of India give the central government the right to issue directions to the RBI in public interest. Now, this is where I say that UPSC always gives you some options where you can eliminate certain chance. You would know that in the Constitution, if you read your polity, do you find a mention of the Reserve Bank of India? Right? You may find mention of the public account, you may find mention of the contingency fund, the consolidated fund. You may have discussed something what is called a money bill or a finance bill or a financial bill for that matter, but nowhere will you see Reserve Bank of India. Who or which act gives the central government the right to issue directions to the RBI in public interest? It is the RBI Act of 1934 itself, not the Constitution of India. Now, this is a statement which commonsensically also you would know why would the Constitution have certain provisions for the Reserve Bank of India. If you use 2 to eliminate the options, then you can eliminate this, eliminate this, eliminate this. Correct answer has to be 1 and 3. Statement 3 says the governor of the RBI draws his power from the RBI Act 1934. This is also a correct statement. That's where he derives its powers from. 159 says, with reference to urban cooperative banks in India, consider the following statements. First, they are supervised and regulated by local boards set up by the state governments. Now, you should know that cooperatives, be it rural cooperatives or urban cooperatives, they are set up and registered under what is called either whichever state's Cooperatives Act, or if the cooperatives are functioning across multiple states, then they are registered under the Multi-State Cooperatives Act. As per this act, you have something which is called the Registrar General of Cooperative Societies, which takes the precedence when it comes to regulating these cooperative banks, especially on their incorporation side, registration side, and such other administrative side. The urban cooperative banks in the country, also called primary cooperative banks, face what is called dual regulation, which means that the banking operations are going to be regulated by the RBI directly, while all other operations are going to be regulated by the Registrar for Cooperative Societies, either under whichever state it is, its own Cooperatives Act, or if it is operating in multiple states, then Multi-State Cooperatives Act. The first statement says they are supervised and regulated by local boards set up by the state governments. No. So you use option 1. The question asks you which of these are correct. That means A cannot be the right answer, C cannot be the right answer, D cannot be the right answer. You obviously know that the answer should be 2 and 3 without even reading 2 and 3. Statement 2 says they can issue equity shares and preference shares, which is a correct statement. Third, they were brought under the purview of the Banking Regulation Act 1949 through an amendment to this act in 1966. The amendment, although was made in 1965, but it came into effect in 1966. Now, statement 2 and statement 3 are statements which may commonly not be known. But statement 1 is a statement that any serious aspirant would definitely know, that urban cooperative banks in the country face a dual regulation. Right? If you know that aspect, you can use 1 to eliminate and get to the right answer without even knowing statement 2 and statement 3. This is the skill of elimination that you have to really work hard on. Now move to the next one. It says, in India, the central bank's function as the lender of the last resort usually refers to which of the following? You should know this. RBI in India is the banker to the banks, is a banker to the government. This is what is called the banking function of RBI. As part of its banker to the banks function, RBI is the lender of the last resort. What it means is that if there are banks which are facing temporary liquidity crisis, but these banks are solvent banks and they tried everything in their means to source this liquidity either from their own banks, from the interbank market, they exhausted all their means yet cannot raise these funds, this liquidity, in which case RBI steps in to lend them this liquidity. This function of the RBI is what is called the lender of the last resort. It is in context of RBI being a banker to the banks, not a banker to the government. Now he's saying, in which context do we use this particular term, lender of the last resort? Option 1 says, lending to trade and industry bodies when they fail to borrow from other sources. Obviously wrong. Providing liquidity to the banks having a temporary crisis. This is absolutely right. Lending to the governments to finance budgetary deficits. Now, amongst these three, even if you don't know, ideally you should know what lender of the last resort means. You should know why would RBI be lending to trade and industry bodies. If you use 1 to eliminate, you at least have eliminated one option. That means the answer could now be 2 only, 2 and 3 and 3 only. Now you should know that, like I said, it is expected out of you to know that what is the lender of the last resort function. It is 2 only, not 2 and 3. Question says, if another global financial crisis happens in the near future, which of the following actions or policies are most likely to give some immunity to India? Now, first one says, not depending on short-term foreign borrowings. Now, this could be a good hedge against a financial crisis, because if you are dependent on foreign borrowings, many a times these borrowings are denominated in external currencies or foreign exchange. That means you may have short-term or long-term, in fact, more specifically in this case, short-term liabilities to pay off in a currency that you don't print. So if you are less dependent on short-term foreign borrowings, it can act as some sort of a shock absorber for you in terms of financial crisis. Second one says, opening up more foreign banks. The problem with opening up more foreign banks is that foreign banks will have their parent company in the native place. For example, let's say the Bank of America. The parent operation has to be in America. It may have subsidiaries in India or it may have branches in India. The more it branches out across the world, it spreads what is called a systemic risk. That means many times what may happen in the parent company, those risks may be rolled over to the subsidiary branches. These branches could be in other countries. That means if one bank fails, especially if the parent bank fails, the repercussions or the ripple effects would be seen across other banks also, because at the end of the day, it's the same bank. So it's going to use up that capital. So if you open up more foreign banks, that means you're exposing yourself to greater amount of systemic risks. So is it likely to give some immunity to India in case of a crisis? Absolutely not. So you use 2 to eliminate the options. B goes, D goes. Now there is a choice between A and C. We know that A is correct. That means the answer clearly has to be A without even reading C. 3, which is maintaining full capital account convertibility. Now, capital account convertibility is the ease with which you can convert your currency into a foreign currency or foreign currency into your local currency or domestic currency, especially on transactions related to the capital account in the balance of payments. If there is more capital account convertibility or full capital account convertibility, because India right now follows what is called a partial capital account convertibility scenario, the fact that we were not allowing full capital account convertibility actually shielded us from the 2008 financial crisis, where your banks were not investing in the bubble that got created because of subprime lending that happened in the US. Because we did not allow full account convertibility is the reason why the ripple effects of the 2008 financial crisis were not witnessed by India. If we had allowed full capital account convertibility, much like Iceland, much like Austria, much like Greece, many of our banks may also have been exposed to that crisis, leading to a possible big problem for the Indian economy. So maintaining full capital account convertibility will not give you immunity, rather it will expose you to once again what is called a systemic risk. The answer clearly is one only. Move to the next question. If you withdraw 1 lakh rupees in cash from your demand deposit account at your bank, the immediate impact on the aggregate money supply in the economy would be, you should know that money supply is currency plus deposits. Money supply is the total stock of all types of money held by the public at any given point in time. The public may hold their money in currency or in the form of deposits. The question says, if you withdraw 1 lakh rupees in cash, that means you had some amount of money in your deposits, you withdrew 1 lakh rupees in cash, that means whatever you withdrew from the deposit will add to your cash balance. The question is, what will be the immediate effect on the aggregate money supply? The immediate effect of this transaction will be nothing, because in the first step itself, your total amount of money remains the same. But if the question was, what would be the impact of you withdrawing this amount from the banking system, from your deposits, and keeping it in cash, eventually, because you are withdrawing some money from your deposits, this means it is going to affect credit creation by the banks. And if credit creation suffers or if it lessens, quite obviously the money supply should reduce because of this action. But the question is, which of these is the immediate effect? Which is why the answer is that it is going to leave the money supply unchanged, at least immediately. That's because the amount withdrawn from deposits becomes an addition to your currency itself. So for the first step, nothing changes when it comes to the money supply. However, subsequently, the money supply should theoretically definitely reduce. Move to the next one. What is the importance of the term interest coverage ratio of a firm in India? Now, interest coverage ratio is EBIT divided by interest expenses. EBIT means earnings before interest and taxation. This is what you call interest coverage ratio. It basically looks at what is going to be your interest expenditure and where do your earnings stand before you have your tax obligations and your interest obligations. That means how much of your earnings are covering for your interest expenses. Now clearly you can see that this is a fraction of the type x by y. So what would you want your ICR to be? You would want your earnings to be higher and your interest expenses to be low. That means you would want to be on the higher side of things when it comes to the interest coverage ratio. Higher ICR means that you have the ability to cover for your interest obligations. First one says, it helps in understanding the present risk of a firm that a bank is going to give a loan to. Yes, because if the ICR is low, that means the earnings of this company or of this bank before interest and before taxation are a little lesser, or conversely it could mean that its interest obligations are higher compared to, it's not higher, are significant in comparison to its earnings. That means there can be a scenario where the ICR for a company or for a bank is low or the ICR is declining, in which case ICR is a good metric for the amount of risks that the bank is presently facing or may face in the future. It helps in understanding the present risk of a firm that a bank is going to give a loan to. Yes. It helps in evaluating the emerging risk of a firm that a bank is going to give a loan to. Yes, if the ICR is continuously declining, it shows that eventually it's going to be a problem. Third one says, the higher a borrowing firm's level of interest coverage ratio, the worse is its ability to service its debt. If you can clearly see, the formula says earnings upon interest expenses. That means if ICR is high, that means compared to the numerator, the denominator is lesser. That means earnings are on the higher side and interest obligations are lower. This is where you would want to be. Higher ICR means that the ability to service its debt is also on the higher side. That means higher a borrowing firm's level of ICR, higher will be its ability to service its debt. Even if you knew the formula of ICR, you would be able to get this question right. You will eliminate D, you will eliminate C. You are left with a choice between A and B, 1 and 2 and 2 only. That means you only have to look at statement 1. If statement 2 is correct, it helps in evaluating the emerging risk of a firm that a bank is going to give a loan to. Most likely statement 1 will also be correct, right? So you go for option A. Let's move to the next question now. The next question says, if the RBI decides to adopt an expansionist monetary policy, which of the following would it not do? Ideally, the word should have been expansionary, but okay. If the RBI decides to follow what is called an expansionary monetary policy, that means RBI is doing something to increase the money supply. How will RBI increase the money supply? If RBI cuts the statutory liquidity ratio, since the statutory liquidity ratio is some amount of a bank's net time and deposit liabilities that it has to maintain with itself in the form of cash, gold, or unencumbered government securities, that means this is the amount that the bank is not going to be able to extend a loan from. Higher the SLR, lesser will be the ability or lesser will be the number of funds that the banks can extend a loan from. That means if the CRR or even the SLR for that matter or both are on the higher side, it affects the bank's ability to create loans. That means if you cut the SLR, the ability of a bank to extend more loans increases, which may lead to an increase in the money supply. That means this one is absolutely correct. The question is, which of the following would it not do? Now, this is a very, very common mistake that students make here. Every time you find a question which has a negation in it, please try to encircle it right then and there before you attempt the question. Because 9 out of 10 questions will be questions where he's going to be asking which of these statements are correct, which of these statements would the RBI do. There are only a few questions, far and few between, lying here and there, where he's asking you for a negation of a statement. So every time you find the word not, please encircle it so that you know that if the RBI wants to expand money supply, would it not cut the SLR ratio? Yes, it will. Increase the marginal standing facility rate? Yes, the marginal standing facility rate would mean that the rate at which RBI allows banks to dip into its SLR requirements to pledge government securities with the RBI to borrow money from it. If RBI wants greater money supply, it should lower the marginal standing facility rate, not increase it. Because if it is increasing the marginal standing facility rate, it means that the cost of funds for the banks is increasing. RBI would want a cheap money regime, not a dear money regime, if it wants to increase the money supply. That means this is something that the RBI is not going to do. So the answer in the first case, will the RBI cut and optimize the SLR? No. That means not this, and not this. The answer has to be option B only. Right? Last is cut the bank rate and the repo rate. Once again, bank rate and repo rate are mechanisms through which RBI injects liquidity into the system. If it wants to increase the money supply, it is clearly going to cut the bank rate and cut the repo rate because it wants to increase the money supply. It wants to follow what is called a cheap money regime. So will it be something that the RBI will not do? Yes, it will be something that the RBI will do, not will not do. That means it should not be in your answers. So you can use 1 or 3 to eliminate your options and you will be back at the right answer. Move to the next question. This one says, consider the following statements. In terms of short-term credit delivery to agriculture sector, district central cooperative banks deliver more credit in comparison to scheduled commercial banks and regional rural banks. Now, if you have done agriculture, there is a theme in agriculture which is what is called institutional credit. There has been a persistent emphasis in the country coming from the government, coming from the RBI, that the amount of institutional credit to agriculture sector in the country should increase, and the government as well as the RBI has taken numerous steps for it. Now, in terms of this, you should know that when it comes to institutional credit, especially in the rural sectors, especially in the agriculture sector, there is a scheme which is called the Priority Sector Lending Scheme, under which banks in India are supposed to keep a certain part of their loans, especially for the agriculture sector. 40% of a bank's adjusted net banking credit should go towards priority sectors, of which agriculture is one. Consequently, because of the PSL, because of the lead bank scheme, the scheduled commercial banks in India typically serve 76% of the rural credit requirements. The regional rural banks and the cooperative banks are in the ballpark of 11 to 12% respectively, both of them. That means, if I'm not mistaken, the scheduled commercial banks are 12%, RRBs are 11%. That means a total of 99% of loans are extended by the SCBs, RRBs and cooperatives. Remaining 1% comes from other microfinance institutions. The highest share is that of SCBs, not of district cooperative banks. So this is something, if you know the structure of banking in the economy, logically also you'll be able to tell that this is the wrong option. Which of the statements are correct? That means 1 cannot be the right answer. 1 only, both 1 and 2 cannot be the answer. One of the most important functions of DCCBs is to provide funds to the primary agricultural credit societies. Yes, there is a 3-tier cooperative structure. At the top, you have the state cooperative banks, followed by the district cooperative banks, followed by PACs, primary agricultural credit societies. So if PACs are in requirement for funds, DCCBs do help them out. So option 2 is correct. That means the answer has to be 2 only. Move to the next question. The service area approach was implemented under the purview of. Now the service area approach was implemented under the purview of what is called the lead bank scheme. Under the lead bank scheme, there had to be a lead bank, which had to be a public sector bank for each district in the country, so that the requirements, the credit requirements of those districts could be serviced properly. The problem is, within a district, there can be many blocks where it may not be commercially viable for a bank to operate. Therefore, this may lead to a concentration of banking activities in a certain part of the district. Following this concentration or accumulation of banking services in a certain part of a district, what was adopted was called the service area approach, which is where in a certain district, the certain district will be divided across multiple service areas, and each service area will be assigned to a bank to meet its credit requirements. This was for greater facilitation of banking services to rural areas, more equitable distribution of banking services to rural areas. So it's a part of the lead bank scheme. Since it's a flagship scheme, you're expected to know this. Move to the next question. Consider the following statements. The Reserve Bank of India's recent directives relating to the storage of payment and settlement systems data, popularly known as the data diktat, command the payment system providers that first, they shall ensure that the entire data relating to payment systems operated by them are stored in a system only in India. This is a correct statement. This is a reference to what is called data localization policy. Since this is sensitive information, the data should be stored in a system only in India. They shall ensure that the systems are owned and operated by public sector enterprises. Now, nowhere is this condition given that the systems should be owned and operated by public sector enterprises. They can be operated even by private sector players. So option 2 is incorrect. That means D cannot be the answer and B cannot be the answer. Now you have to choose between A and C. Quite obviously the answer has to be A. B says, they shall submit a consolidated systems audit report to the CAG of India by the end of the calendar year. Now you should be able to tell as to why would a payment and settlement systems provider submit a report to the CAG, to the Comptroller Auditor General of India. This is a ridiculous statement to make. If you have known enough polity, you would clearly know that this is quite ridiculous. Why would 3 be the case? So even if you use 3 to eliminate, you would be able to eliminate option D and option C. You will still be left with 2 options to pick from, 1 only and 1 and 2 only, right? And between 1 and 2, it is 1 which looks more correct than 2. So you can make a reasonable guess also. Move to the next one. It says, what was the purpose of the inter-creditor agreement signed by the Indian banks and financial institutions recently? Now, this is a question based out of current affairs from 2019. What was happening was there was a huge payment and you can say pending NPA crisis across the country. Inter-creditor agreement was for the quicker resolution of non-performing assets. Under the inter-creditor agreement, which was a notification pushed by the RBI, which was later revoked, the borrowers, or you can say the creditors of a company should, through a mutual consensus, through an inter-creditor agreement, try to expedite the resolution of a non-performing asset as expeditiously as possible. Now, this is a question based out of current affairs for that year. So it is obviously very easy for people for that year. The answer is to act as an independent regulator in case of applications of a loan for 50 crore or more. No. To aim at faster resolution of stressed assets of 50 crore or more, which are under consortium lending. Because there is a consortium lending, quite obviously there will be an inter-creditor agreement. Right? Answer has to be D. Move to the next one. The chairman of public sector banks are selected by. And the question is, who will select the chairman of public sector banks? It is the Banks Board Bureau. Once again, a question that does not merit any discussion. Very simple question to answer. Which of the following is not included in the assets of a commercial bank in India? Now, you should know assets are where you're expecting a return. Liabilities are something that you have to pay back, sometimes also with interest. For any bank, its deposits will be its liabilities and assets will be its loans. Clearly, there are other assets too, there are other liabilities also. But primarily for a bank, it is in the business of converting its liabilities into its assets. Now, he's asking which of these is not included in the asset side of a commercial bank. So if you obviously find deposits, that will be the right answer. The question clearly is deposits, because deposits are liabilities on a bank. If it's a demand deposit, the bank is liable to pay the money on demand. If it's a time deposit, the bank is liable to pay the money, principal plus the interest, after the time is over. That means deposits are liabilities, not assets. Very, very easy question. Anybody would be able to get this right. Which of the following is issued by registered foreign portfolio investors to overseas investors who want to be a part of the Indian stock market without registering themselves directly? The answer to this question is participatory note. In the past few years, instruments of the capital market, instruments of the money market, there are many questions relating to these aspects. Previously would not be the case. Previously it was the banking sector from which most number of questions were asked. Right? You should know by definition what is a participatory note. In case of a participatory note, if there is an investor who does not wish to move to India or to register with the Indian authorities, and at the same time also wants to invest in India because it to him looks like a favorable destination, what this person is going to do is going to connect with a foreign institutional investor which is registered with SEBI in the country, and through this investor invest his money in India. The FII, registered FII, is going to issue him a financial instrument. This instrument is called the participatory note. Move to the next question. Which of the following is not the most likely measure that the government/RBI takes to stop the slide of Indian rupee? The slide of Indian rupee would mean that the rupee is losing value. And if the rupee is losing value in comparison to a foreign currency, it means that the rupee is depreciating. He's asking you which of these is not the most likely measure that the government or the RBI is going to take to stop depreciation. The question is not. First one says curbing imports of non-essential goods and promoting exports. Now, quite obviously, if you are curbing imports, that means less foreign exchange is going to go from the country and more foreign exchange is going to come in comparison, because you should know NX equals X minus M. If you are attacking imports, that means if you want to reduce imports, you will be having relatively more exports. Consequently, an increase in the forex from the rest of the world. An increase in the forex or increase in supply of foreign currency is going to put an appreciating pressure on the rupee, and it will prevent depreciation. That means, is it something that the government will not do? The government will do this. Clearly, it will not be the right answer. D is encouraging Indian borrowers to issue rupee-denominated masala bonds. Yes, masala bonds are instruments through which Indian entities raise money from external markets by issuing securities, but these securities are denominated in the Indian currency, which is the rupee. If you issue more masala bonds, typically what you're doing is you're hedging yourself against currency risks. That means in case of a slide of in the Indian rupee, this is going to be a good step because you're hedging your currency risks. C says easing conditions related to external commercial borrowings, and D says following an expansionary monetary policy. If external commercial borrowings are made easy to do, quite obviously external commercial borrowings could be used to bring forex into the economy. Much like reduction of imports is going to be used for conservation for existing forests, and external commercial borrowings could be used to bring in more forex into the economy. So this is also a good step, and hence not the right answer, because the question is which of this is the government or the RBI not going to do. The last is following an expansionary monetary policy. If you follow an expansionary monetary policy, this means that the money supply in the economy is likely going to increase. Higher the money supply, higher the funds with the banking system. That means the interest rates should decline. And if the interest rates in the economy decline, you will find many people would want to move to a foreign destination or would want to move their savings to a foreign destination. That means the demand for foreign currency is going to increase. Many people will be willing to dump their currency in favor of the foreign currency, leading to a depreciation of the domestic currency. So this is something that the government is not going to do. The next question is, with reference to digital payments, consider the following statements. First one says, Bhim app allows the user to transfer money to anyone with a UPI enabled bank account. Now that we are in the age of UPI, I don't think this merits a discussion even. Yes, the Bhim app allows the user to transfer money to anyone with a UPI enabled bank account. Second says, with a chip and pin, while a chip pin debit card has 4 factors of authentication, Bhim app has only 2 factors of authentication. Now, Bhim app has 2 factors of authentication. One is called the knowledge factor. The other one is called the possession factor. That means you have to possess the phone in which you have your Bhim account or in which you have the Bhim app, and you should have the knowledge of the pin. Similarly, for a chip and pin card, you have to have 2 things, which is possession of the card and you should know the pin of the card. That means a chip and pin card also has 2-factor authentication. Bhim app also has 2-factor authentication. Now remember, this is a question from 2018. So back in the day, 2-factor authentication only. That means option 2 is incorrect. Option 1 is correct. The answer should be 1 only. Now let's look at the next question. Which of the following links all the ATMs in the country? First one says Indian Banks Association. Second one says National Securities Depository Limited. Now clearly this cannot be the right answer. C says National Payments Corporation of India, and D says Reserve Bank of India. Why would Reserve Bank of India link all the ATMs? It is the NPCI. NPCI owns what is called the National Financial Switch, which is a network which seeks to enable all ATMs to be ubiquitous, which is that you can use any card of any bank across any ATM in the country. That means these ATMs should be on a common network. This network is called the NFS, the National Financial Switch, which is owned by the National Payments Corporation of India. Answer should be C. Move to the next one. Which of the following best describes the term merchant discount rate, sometimes seen in the news? Now, merchant discount rate is the charge to a merchant by a bank for accepting payments from his customers through the bank's debit cards. Remember, the name may look like the merchant is being given a discount, but MDR essentially means that if you're using, let's say, a card, if you're using some other payment aggregator's service, that card operator or the card network owner or any other payment service provider is going to charge you for using that particular service. That charge is what is called the MDR, merchant discount rate. Back in the day, there was a lot of discussion over how UPI at this point in time does not have a merchant discount rate. That means all transactions on UPI right now are free, which is why we also call UPI a public good, digital public good. Move to the next one. Which of the following statements are correct? First one says, capital adequacy ratio is the amount that the banks have to maintain in the form of their own funds to offset any loss that banks incur if the account holders fail to repay dues. In the first question also, I told you there has been an increasing stress since the Basel Committee on Banking Supervision came up with what is called the Basel norms. Basel Accord 1, Basel Accord 2, Basel Accord 3 prescribes some capital adequacy norms, which is where they want that the banks should hold significant part of their chunk of their, you can say, funds in the form of tier 1 and tier 2 capital. The ratio of banks tier 1 and tier 2 capital to its risk weighted assets is what is called the capital adequacy ratio, also called the capital to risk weighted assets ratio. And it is indeed a measure of their own ability to offset any loss if the bank suffers from losses, because this is bank's own capital. Second says CAR is decided by each individual bank. No, CAR was prescribed by the BCBS, the Basel Committee. However, the Basel Committee can only make a recommendation. This recommendation is not liable to be accepted by all central banks. It is the central bank of an economy which will get to decide what the capital adequacy ratio would be. For example, in our case, RBI generally offers or generally recommends, or you can say recommends, to have a higher CAR compared to the Basel Committee itself, right? Not decided by each individual bank, but decided by the central bank, which is the RBI. First one is correct. The second one is not. Answer is one only. Move to the next question. Which of the following statements correctly describes the meaning of legal tender money? Now, legal tender money is money that you cannot deny being paid in the form of. That means you are under a legal compulsion to accept payment in the form of this money, which is why it's called a legal tender. Now, in this, the money which a creditor is under compulsion to accept in the settlement of his claims. This is the answer, option B. Very, very simple, very, very straightforward question. Move to the next one. It says, consider the following statements. Which of these statements are correct? The Reserve Bank of India manages and services the Government of India securities, but not any state government securities. Now, this is an incorrect statement. The Reserve Bank of India is the public debt manager both for the Government of India, and the Reserve Bank of India also manages securities on behalf of the state governments, which are typically called state development loans. Now, you may confuse yourself here thinking that state governments do not issue securities. State governments cannot issue T-bills or treasury bills. They can always issue what is called dated securities, which is what is called the state development loans. And it's the RBI which manages the debt on their behalf. So the first statement is wrong. If the first statement is wrong, you use 1 to eliminate. You have eliminated option A and option D. Now you are left with the choice between C and B. C says 2 and 3, B says 3 only. That means 3 is assumed to be true. You have to check for 2. 2 says T-bills are issued by the Government of India and there are no treasury bills issued by the state governments. This is the correct statement. State governments do not issue treasury bills. It is only the Government of India, central government, which issues treasury bills. However, state governments do issue what is called dated securities. That means government securities of a tenure more than 1 year. So this is correct. Answer should be 2 and 3 only. 3 says T-bills are issued at a discount from the par value. Yes, T-bills are short-term debt instruments which are zero coupon securities. That means they're not going to offer you a coupon rate. They're going to be issued at a discount on the face value to be redeemed at the face value upon the maturity of this particular security. Let's move to the next question. With reference to the governance of public sector banking in India, consider the following statements. First one, capital infusion into public sector banks by the Government of India has steadily increased in the last decade. Now, this is a question which is typically the favorite of UPSC, where UPSC asks you questions on trend lines. Here he is asking you that capital infusion, government infused capital into public sector banks, and that capital infusion has steadily increased. Steadily would mean that year on year you will find that there is an increase in the amount of capital infused by the government into public sector banks. Now remember, this is a question from 2018. He's saying with reference to the governance of public sector banks, consider the following statements. In the last decade, that means 10 years starting 2018 and backwards, has it been the case that capital infusion would definitely have increased from the government side? Now 2018, 10 years back is 2008. Now from 2008 till about 2018, if you know plans very well, 2008 is when you had the global financial crisis, where the repercussions of those crises were not felt as badly by India. Capital infusion started after we started discovering what is called the NPA problem in the banks, typically which was caused by the exposure of many banks, public sector banks, to infrastructure loans. Those projects were not taking off. Eventually, the government decided to increase its capital infusion, but because the statement is a rather extreme statement, which is saying that it has steadily increased. Now, this should be your basis to think of this statement as wrong, which it is factually wrong. Second says to put the public sector banks in order, the merger of associated banks with the parent state bank has been affected. Now, back in the day, it was current affairs. And yes, there are many times that this recommendation has been made that you want to have big banks which will become systemically important banks, banks which are too big to fail. Right? So, State Bank of India was merged with its associates, for example, the State Bank of Bikaner and Jaipur, State Bank of Travancore, State Bank of Mysore. Right? These were merged into the parent company, which is the State Bank. The idea was to improve It's governance. So the answer to this question will be 2 only. Move to the next one. Consider the following statements. First one says NPCI helps in promoting financial inclusion in the country. This is correct because NPCI typically is related with giving newer and better payment and settlement systems, which are being also offered in a more affordable and accessible manner. It is the NPCI which has launched RuPay. It is the NPCI which has launched Beam and also other Aadhaar enabled payment systems. So the first case is correct. The second state is also correct. The answer has to be both 1 and 2. Which of the following statements best describes the term scheme for sustainable structuring of stressed assets recently seen in the news? Now remember, this is a question from 2017. This is a question in the context of what used to be called the twin balance sheet syndrome, where the balance sheet of both infrastructure companies and banks in India was worsening. The scheme for sustainable structuring of stressed assets, also called S4A, was seen in context of what? First one says it's a procedure for considering ecological costs of developmental schemes formulated by the government. Not the correct answer. It is a scheme of the RBI for the reworking of financial structure of big corporate entities facing genuine difficulties. No, it's not got to do anything with the financial structure. C, it's a disinvestment plan of the government regarding central public sector undertakings. Absolutely incorrect. And D says it is an important provision in the Insolvency and Bankruptcy Code recently implemented by the government. D is absolutely incorrect. That means the answer should be D. Scheme for the RBI for the reworking of financial structure. Under this scheme, what happened was to resolve certain loans. What was done was you would restructure the loan terms, which is some of the loans could be converted into equity. Under S4A, the amount of loans that could be converted into equity, the government did not want equity of more than 51%. That means it did not want any management and ownership control in these companies because it trusted these companies to revive itself. That was what is called the S4A. This is against what is called strategic restructuring of debt, where debt would be converted into equity of 51 or more percent. Answer is B. Move to the next one. Which of the following is a most likely consequence of implementing the UPI? First is mobile wallets will not be necessary for online payments. This is obviously correct. If you remember, before UPI, there was a time where we were making payments through wallets. That you had MobiKwik ka wallet, you had Paytm ka wallet. After UPI was brought into force, there is no requirement of an intermediary wallet before you make a transaction. You can make a transaction from one account to the other account if both of you are Bheem enabled or UPI, rather UPI enabled, not Bheem enabled. So the answer would be A. What is the purpose of setting up a small finance bank in the country? Now remember, small finance banks are full service banks. The idea behind having a small finance bank was to service the banking requirements of the underserved or unserved segments of the society. This is what the idea was. First was to supply credit to small business units, could be underserved, so great. To supply credit to small and marginal farmers, once again, could be underserved, so could be a likely option. C says to encourage young entrepreneurs to set up businesses, particularly in rural areas. Now, amongst the three, young entrepreneurs was never mentioned as a reason behind SFBs. SFBs were brought into force to support underserved or unserved banking requirements of certain segments of the population. That means 3 can be used to eliminate the options. The answer is 1 and 2 only. We'll move to the next one. Which of the following statements is or are correct regarding the Monetary Policy Committee? First one says it decides the RBI's benchmark interest rates. This is absolutely correct. The inflation target is set by the central government in consultation with the RBI. However, the policy rate, the benchmark policy rate, is decided by the MPC, the Monetary Policy Committee. This decision is applicable to the functioning of RBI. The RBI will have to accept this particular policy rate. Second one says it's a 12-member body, including the governor of RBI, and is reconstituted every year. It's not a 12-member body. It's a 6-member body. 3 members coming from the RBI and 3 coming from the government. So 2 can be used to eliminate. This goes. That means the options are between A and C. We know that A is correct. The answer should be A. 3 says it functions under the chairmanship of the Union Finance Minister. No, it functions under the chairmanship of the governor of RBI. Now let's move to the next question. The establishment of payment banks is being allowed in India to promote financial inclusion. Which of the following statements is or are correct in this context? First one says, mobile telephone companies and supermarket chains that are owned and controlled by residents are eligible to be promoters of payment banks. Now, if you were aware, in 2016, one of the payment bank licenses went to Airtel. So if you knew that, you would know that yes, mobile telephone companies are eligible. This is a correct statement. Second one says payment banks can issue both credit cards and debit cards. The idea behind having payment banks, which are an example of vertically differentiated banks or niche banks, was to support payment and settlement systems in the country, to enable cheaper, more accessible, more affordable payment systems for the various segments of the economy. The idea was to issue debit cards for sure, because these are payment banks, but because payment banks are not full service banks, they cannot issue credit and hence cannot issue credit cards. Now, if you look at statement 3 says payment banks cannot undertake lending activities. Yes, they can accept deposits, but they cannot undertake lending activities. Now, one thing you should be clearly seeing here, if statement 2 is correct, then 3 cannot be correct. And if 3 is correct, then 2 cannot be correct. If you are issuing credit cards, then you are basically giving loans. It's a deferred payment, but technically it's credit. And here you are saying payment banks cannot undertake lending activities. That means 2 and 3 cannot be correct at the same point in time. You will have to take a call which one, right? The answer clearly is cannot undertake lending activities. Yes, payment banks can issue both. No, this is incorrect. You use 2 to eliminate. The option is 1 and 3 only. Now remember, 1, 2 and 3 cannot be the answer because 2 and 3 are contradictory to each other. Move to the next one. The term core banking solution, sometimes seen in the news. Which of the following statements best describes this term? First, it's a network of banks branches which enables customers to operate their accounts from any branch of the bank on its network regardless of where they open their accounts. This is exactly what core banking basically means. That you may have an account with one branch of a certain bank. The same bank or any other branch of this particular bank can also service your banking requirements because this bank is on the core banking network or the core banking solution. This is correct. Second one says it is an effort to increase RBI's control over commercial banks through computerization. Now, this is not an effort wherein RBI is trying to control banking activities. This is an effort to facilitate better servicing of consumer requirements, customer requirements by the banks. So 2 is incorrect. You use 2 to eliminate. The options now are 1 only, 1 and 3 only. That means 1 is supposed to be correct. We have to look at 3. 3 says it's a detailed procedure by which a bank with huge non-performing assets is taken over by another bank. No, this is not what core banking basically means. So can't be C. Option is A. Now let's move to the next question. What is or are the purposes of the MCLR, marginal cost of lending rate, announced by the RBI? Now, marginal cost of lending rate is an internal benchmark which should be used by banks to change their interest rates. Essentially speaking, the RBI does not tell you or does not tell the banks what their spread should be. The RBI only wants that the banks should follow a certain benchmark so that any change in the benchmark rate would also lead to a change in their savings as well as their lending rates. And the consumers should have full transparency. They should have an account for why the certain rates are changing. This is good for consumer awareness. This is good for monetary policy transmission. Right now, the RBI is stressing upon the banks adopting what is called external benchmarks. This is an internal benchmark though. These guidelines help improve the transparency in the methodology followed by banks for determining interest rates on advances. Absolutely correct. Because if you link interest rates to a benchmark, so if the benchmark changes, the interest rates for the banks will also change. So it gives transparency to the system. Second one says these guidelines help ensure availability of bank credit at interest rates which are fair to the borrowers as well as to the banks. This is also correct. The answer has to be both 1 and 2. That means you are not irrationally pricing your interests. Move to the next one. It says, Pradhan Mantri Jan Dhan Yojana PMJDY has been launched for. The idea is to promote financial inclusion in the country. You want everybody to have an account, to hold a bank account, so that they are financially included in the economy. Simple question. When the RBI reduces SLR by 50 basis points, that means 0.5%, which of the following is likely to happen? If the RBI reduces SLR requirements, then it means that the banks are now free to extend more loans by 0.5% of their NDTL. First one says India's GDP growth increases drastically. Now, a decline of merely 0.5% in SLR will not, it may contribute to the GDP growth because of credit creation, but the word drastically makes it a little too extreme. Second one says foreign institutional investors may bring more capital into our country. Now, this is a little less likely, because if you reduce the SLR requirements, that means there will be more funds available for banks to extend loan from. They should, typically speaking, have a declining, you can say, or a decreasing impact on the lending rates. If banks are offering lesser lending rates, that means they will also be offering lesser saving rates. And if the banks are offering lesser savings rates, that means other destinations must be slightly better in terms of a savings destination. It should lead to a flight of capital from India, not capital incoming into India. So second is absolutely wrong. C says scheduled commercial banks may cut their lending rates. Yes, they may cut their lending rates now that they have to keep less part of their NDTL as reserves with them. D says it may drastically reduce liquidity to the banking system. Firstly, if you cut SLR, it will increase the liquidity into the system, definitely not reduce it. Secondly, anything will not be drastically done. So can't be D, answer has to be C. Let's move to the next question. The Basel III Accord, or simply Basel III, is often seen in the news. It seeks to, first, develop national strategies for the conservation and sustainable use of biological diversity. Now, if you have been just a student of economics, you would know that the Basel Accord is not for biodiversity. B says improve banking sector's ability to deal with financial and economic stress and improve risk management. This is the idea. The committee was Basel Committee on Banking Supervision. It prescribes norms which are called Basel norms or Basel Accords, Basel I, Basel II, Basel III. Basel III was in the aftermath of the 2008 crisis, wherein the Basel III Committee, essentially speaking, the Basel III Accord essentially wanted the banks to increase their minimum capital requirements. So they increased the capital adequacy ratio. They also introduced what is called capital conservation buffer, and also introduced an optional counter-cyclical capital conservation buffer. This is because the Basel norms were introduced in the 1980s, and since then, right, they had been stressing on banks maintaining a great amount of their money in the form of their own capital, be it tier 1 or tier 2. Regardless of that, the global financial crisis of 2008 happened, especially coming from banks itself, which is why Basel III became a little more stringent and added 2 more capital requirements. Answer is to increase the resilience of the banking sector to economic stress and improve risk management. Very, very easy question. With reference to the Indian economy, consider the following. First one, bank rate. Second one, OMOs, open market operations. Third one, public debt. And fourth one is public revenue. Which of the following are the components of monetary policy? Now, public debt cannot be the component of monetary policy. Public revenue cannot be the component of monetary policy. It could be a component of the fiscal policy, not the monetary policy. First is the bank rate. Bank rate is an example of an indirect monetary policy instrument, quantitative at that. And open market operations are also included in the monetary policy framework. So the answer has to be 1 and 2. Okay, we'll take the next section, which is on inflation.